Welcome to TMS Insights. It's early April 2020. We've been through one of the most volatile and vicious periods in the market in a long, long time. Ben Clark and Jeremy Hook bring you a very different TMS Insights. We're practicing social distancing. Ben's in the office. I'm working from home, and things are a little bit different at the moment, but normal service does continue at TMS. Ben, certainly been through March into early April, one of the most hectic periods we've seen in the market for a long time.
Yeah, it's I think in 23 days, Jeremy, we saw a 40% correction on the ASX, and that puts any bear market that we've seen in the past, well in the back sort of mirror. In the GFC, I think it took 12 months and 1 week to fall a corresponding sort of amount. So it was the speed of the sell-off that was that brutal, and certainly something that's pretty historic, along with the complete uncertainty about the virus that caused the correction.
The speed of it was immense. Obviously, at the start of it, nobody really knew how long it would go on for. We've been practicing being virologists in the last few weeks and trying to understand the nature of a pandemic and looking back into history over 100 years to get some sort of sense of how we can see how this might play out. But what we're learning, I guess, is that this is obviously a massive global issue. The health issue is the first one. The panic issue, both within economic and within safety issues, is obviously paramount. And then obviously purely just the economic issues. To me, it just has that normal look, though, Ben, economically, of a typical sort of bear market beginning at the moment.
Yeah, I think the bizarre thing about the coronavirus and the implications for the share market is you've got the health consequences and then you've got the economic consequences, and they're banging up against each other. You can't. What's become clear is, if you want to give your country's citizens the best potential health consequences, you have to do the maximum amount of damage to your economy, and vice versa. If you want the economy to hold up in reasonable shape, you have to, probably give your citizens the worst possible health consequences. And so governments around the world are trying to find where that balancing line is between how much pain do we cause our economy in order to try and keep as many people as alive as possible, and to try and take pressure off the hospitals that we know are going to be potentially overrun. And different countries are employing very different sort of tactics. We're seeing countries such as Sweden and the Netherlands are literally just letting this cycle through their population and doing absolutely nothing about it. That's probably the one extreme. And then, you've got the other extreme, which would be countries like South Korea and Singapore and probably Australia, you'd almost put in there now, where max testing, the lockdowns that we all know about. So I think this argument, Jeremy, we've spoken about it, is going to keep evolving. I think there is a growing view that there's only, it sounds bad to say it, but there's only so much health pain that we can cause at the expense of our economy. And there needs to be an economy to come back to once we've got through it. But look, adding on to that, most countries in the Western world are now at or very close to the peak of the virus, so that we know that we're getting close to the topping out or the flattening that we've been hearing about so much. But I think, and I'd be interested in your thoughts, is the market's attention is really turned on to the economic implications of what governments have been forced to do to try and stop the spread of the virus. And that, for me, is the big uncertainty going forward.
Yeah, so on the economic scenarios, we start talking about alphabet outcomes, whether it's a V-shaped recovery, a very short, sharp one with a very short bounce up, or a U-shaped recovery where it's a long bottoming after a steep fall, and then eventually we get back to a sudden rise of activity. Or there's the L-shape, which is a long period without that up. We don't know when that up is. And economists are playing this out. When they look back at previous pandemics, V does look like something that is a possible scenario, but in our discussions, we're tending to feel that that's probably less than likely. U-shape, which is a period of consolidation and the market repairing itself, the economy getting back on its feet but taking a bit of time to do it. That's the most likely scenario we feel. And then the L-shape, which is, a pretty dire scenario, quite honestly, and is probably going to be likely to be the case in the countries which haven't acted hard and fast then and haven't brought, like Australia has, really fast stimulatory activity to their economy.
Yeah, and I think that's the big uncertainty is how governments react to this. We've seen massive fiscal stimulus announced by a lot of the big Western governments around the world. Central banks have clearly got together and are literally doing whatever it takes to keep liquidity flowing in global markets and provide as stimulatory an environment as they're able to manipulate. But whether we get the V, the U, or the L, the answer will be driven by how efficiently and effectively governments are able to nurse the economies around the world through this lockdown period, and then how quickly they reopen these economies up and get everyone going back to work and moving and that sort of thing again, whilst trying to balance what the health consequences of that look like. And I tend to agree with you. I mean, we've been speaking about this frequently, but I think it's going to be somewhere in the middle. The fiscal stimulus that has been announced is massive. It's on a scale that mankind has literally never seen before. So governments are doing literally everything they can, but it has to be smartly spent. And there's a lot of issues out there in terms of trying to help companies, with debt get through this period if there are good businesses. The banks, of course, have got a big responsibility to play and it's a very fine balancing line between trying to keep businesses going, but also making sure they get their money back if they think they're not going to get through it. That's a tough line itself. And we're probably going to see, I think, some countries that handle this much better than others. Australia, I would say, seems to be doing a really good job where we're at right now. The question will turn, though, to what does the reopening of this country look like, and how quickly does it happen? And the one thing I would add is that there will be a vaccine developed from corona. It's probably at least a year away. But the widespread release of a vaccine, which huge resources are being thrown at as well, that will be ultimately the catalyst for the full reopening of borders globally and hopefully the globe to move ahead.
Bring it back to the market itself. Now, we know that a lot of companies have been really badly hit, having to lay off totally a lot of workers, shut down their business. They're actually not selling anything at the moment.
Yeah.
And a lot of those companies are ones who come to market to say, we need a capital raising. We need to raise money from shareholders to get us through. And this is a time when we see great opportunity for potential returns in some places. Yes, some of these companies have gone down in price to a certain level now, but the raisings are being done at an even better level, Ben. And within this is a great opportunity. So we'll be talking to clients, we have been already in the last few days, because some of these raisings are right in front of us and others are coming up. But this is a time when people should be pretty excited about how good the value opportunities can be.
Yeah, and if there was one lesson I learned through the bear market of the GFC was, just how fruitful these raisings can be. So, look, I think a couple of points I'd make to clients. Firstly, is it's highly likely that you don't really need to be paying market prices to buy quality businesses over the next 4 to 6 weeks, whatever it is. A lot of companies, and these are in many cases very good businesses, are issuing shares at large discounts to their current share price. And in fact, if you look at Cochlear as an example, at a price that the business had never actually traded at through the worst of the correction. of course, there is also a limit to how much money clients can physically continue to put in as they're requested it from businesses. And that's probably one of our biggest challenges that we will have working for clients for the rest of the year, actually, I think, is trying to get that way up between wanting to take advantage of these raisings because they are going to be very attractively priced and you want to be doing something about it, but not putting all of our cash into the market, even if the deals are great. Finding that balance between, in many cases, it will be being more active than we typically are. So that might be selling shares on the market in a business with the knowledge that we can buy them back in a raising. And it will also mean that we've got enough cash up our sleeves to take advantage of opportunities in the future. I think one thing we both agree is we're not through the worst of this news and the outlook for the economy yet. The market might have seen the low. We'll know that in hindsight a couple of weeks ago. But there will be opportunities that continue to present. But I think the capital raising area is going to be a good one to be a part of.
Yeah, exactly. I agree with all of that. And I think the point here for an investor is don't hibernate. If the economy is hibernating, there's opportunities there. So, in fact, we're more active than not active. So we can't always be on the phone, but we will be on email and we'll be in touch. And we're more than happy to respond to questions about these things. But these opportunities you've got to be on top of and aware of and moving pretty rapidly. So sometimes the market just let you be inactive and that's the best way to be. These sort of markets require a bit of attention and you do have to be a bit more opportunistic, I think. So,
yeah.
Ben, before we leave everybody, also in amongst these big changes and tax decisions and the like, there was a decision made about pension payments as well, which would be good to make everybody aware of, that there was a halving in the minimum requirements to be drawn down for this and next financial years.
Absolutely. So that means basically if you don't need as much money out of your super fund for living expenses, etc., you're better off retaining that cash in your super fund and drawing on assets outside of super. We all know how hard it is these days to get money into super and to build that balance up in a very effective tax environment. So if you need to speak to anyone about that, there's a number of guys in the office who can run through it. I think also, Jez, another point I wanted to raise was the international shares that we've been speaking about for the last year. And it's not just keeping the blinkers on the Australian market. There's some pretty good opportunities. We've continued to be looking at businesses in America. Visa and MasterCard are two companies that we've actually spoken about, I think, on one of the videos a while ago. They've had quite decent pullbacks in price and now look like pretty well priced. So, a part of a lot of clients' portfolios who sort of took the advice to, open the scope and to look at some investments outside of the Australian share market, it's actually done incredibly well. A lot of those shares are actually flat to up this year, quite amazingly. And the Australian dollar, of course, has helped that. But the share prices have proven to be quite resilient. So that's another thing, I think, for clients to keep in the back of their minds.
Yeah, and we'll mention a bit more of them on the next such video where we'll talk about some of the stocks that will actually do better in this kind of environment. And a number of those are some of the big name stocks that we have and have it watch on in the US. So absolutely. Well, we're going to wrap up the video here. Just a couple of things. One is to all our clients and viewers, hope that you're all staying safe and well and managing what is obviously a difficult time for everybody, but also to our terrific staff at TMS. Everybody's had their head down, very busy. Most people at work, but a few have been at homes, different days working. So we're making sure that we're going to be around to be able to keep working for you, our clients, and looking forward to this busy time, but also a nice break over the Easter weekend, which is coming up. So that's all we've got time for on this Insights. We'll be back later in April with a bit of an update as this whole situation is moving so fast.